So, good evening, everyone. It's great to see you all at our online meetup. So I guess you know that today's lecture is held in English. So we decided that it would be suitable to hold the whole meeting in English, like 100% in English. So please ask your questions in English. If you communicate in the chat, please do it in English, so you could feel like the atmosphere of studying at our master's programs. The topic of today's lecture is Porter's 5 forces. And the speaker, I guess you know, but I will tell. It is Hachatур Леваевич Авалян. He is a professor of HSE Banking Institute of our master's programs as well. So, Hachatур Леваевич, the floor is yours.
Good evening, dear colleagues. My name is, as Rita has mentioned, Hachatур Авалян, and I'm one of the guys who are leading the equity investments class in the master's program. And just to give you the flavor and what it is like to have this lecture, please let me show you. We will take a small excerpt from the actual lecture. And just to make it interesting, we decided to pick up a topic which is related to industry analysis, just to make it hopefully interesting to you. And this small introduction would be followed by a couple of questions to you, open-ended questions, just to see your thoughts on this. Okay, so today we're going to talk about industry strategic analysis, and I will make a particular focus on Porter's 5 forces, but in general, since we are talking about equity investing, it is important to understand what is the context or what is the environment where a particular company is operating, because equity investing has to do with evaluating whether a particular share of stock is overvalued, undervalued, and basically we are diving into the subject of understanding how do we come up to a particular price for a particular stock. Later on in the program, we will of course explore this in much more detail, but in general, when it comes to understanding as to how to value equity in particular, strategic industry analysis is of great importance. As I said, it helps you understand the environment where the company is operating. So when we say industry analysis, we do this for the sake of understanding the environment. In an active management strategy, and what we mean by active management strategy, this is when you buy and sell stocks hoping to find over or undervalued securities to make up a profit. Of course, it all hinges on the assumption of whether the markets are efficient or not. In plain language, it simply means that in the market, some securities might be overvalued or might be undervalued. Of course, as an investor, you're interested to look up into this mispricing and pick the stock that is either over or undervalued. If it is overvalued, you can short the stock, borrow the stock from the broker and sell it. And then later on, if you happen to be correct, the price goes down, you will deliver the stock back and keep the difference in your pocket. Or if the stock is undervalued, then you would want to buy them. And by the time the price goes up, you will sell it and hence make a profit. This is what active management strategies are in general. So industry analysis can help you identify the industries which are over or undervalued. So I started off from talking about over or undervalued securities, and then we move on one level up to talk about over or undervalued industries. And in active management strategy, you want to overweigh or underweigh the industries based on the business cycle phase. What we mean by this? So different companies, different industries react differently to the different stages of the business cycle. Okay, when we talk about industry, how do we characterize an industry? What is an industry? There are different ways we can go about this. For example, we can divide industries into the products or services that they deliver to the market, or by how sensitive a particular industry is to the different stages of the business cycle, or by using different statistical methods that group the firms with their historical correlation and returns. But most of the time, we would be probably doing the looking up at the products and services as a way to characterize what an industry is. And we would also resort to understanding the sensitivity to the stages of the business cycle. Businesses, so what are the characteristics of industry in general? For example, when it comes to evaluating the sensitivity of the industry to the stages of the business cycle, we can look up at the earnings and how the earnings of the industry are sensitive to the stage of the business cycle. So the business or economic cycle, as you know, is composed of the trough, the growth stage, the peak. Let me show it to you, make it more interesting. This is basically economic, from economics. So this is the typical business cycle, something like that. The peak, the peak contraction phase, recession, then the trough, then the growth stage, then we can come to the peak, etc. So different industries have different sensitivity of their earnings depending on the stage of the business cycle. As such, we can categorize industries into cyclical industries, those whose companies' earnings are highly dependent on the stage of the business cycle. So what do we mean by this? If the economy is on the rise, the earnings are growing rapidly, or in other words, the revenues are growing faster than the expenses. And usually the cyclical industries are characterized what we call as high operating leverage. That is to say that the proportion of fixed costs is significant. That's why at the growth stage of the business cycle, the revenues will be growing faster than the cost, because a large proportion of the costs are fixed. And there are different examples of this kind of industries. Or they can be non-cyclical industries. The demand is relatively stable over the business cycle. We can further on subdivide into defensive industries, which are least affected by the business cycle, and growth industries that are largely unaffected. For example, during the early 2000s, the telecoms could have been considered a growth industry. So, by the way, dear colleagues, you can interrupt me at any time in today and in the actual sessions. I do encourage students to interrupt me at any time because I really don't want you to have any blind spots, okay? So I mentioned high operating leverage. What do we mean by this? And once we cover this, we will finally get back to the Porter 5 forces, which has been announced. So imagine we have two companies, and let's say I call one company A, the other company B. And let's say these both companies are producing the same item, the same product. What product we can think of? For example, we can think of handbags. Company A is producing the handbags largely using variable costs, the costs that go up and down with the level of activity, while the company B is using more equipment to produce this same handbags. I'm just using a fictitious example just to give you an idea. Okay, so let's say both companies start off with 1,000 revenues, company A and company B, and let's imagine that both companies' revenues would increase by 10%. What would happen with the bottom line, which here we measure as operating profit? As you can see, the variable cost will increase by 10% because they are variable. They go up or down, go up and down with the level of activity or level of revenues here. The same pertains to company B, but because company B has a larger proportion of fixed costs within the cost structure, the variable costs are less. So what will happen with the bottom line, with the operating profit of these two companies? At the steady state, at the base case, they both have $150 or any other units that you can imagine. I'm a little bit speeding up if you don't mind. If you find my pace too fast, just let me know in the chat box, okay? Because I really want to cover as much as possible to give you an idea as to what it is like to have an online Zoom type of lecture. So, as you can see, the revenues have increased by 10%, in both cases. The variable costs have also increased by 10%. What happens if we take the difference between the revenues and the variable costs, we will get to what we call contribution margin. Okay. The contribution margin has also increased by 10%. Now, an interesting thing happens when we look at the fixed costs. Fixed costs are fixed, as the name suggests. They do not change with a change of revenue. They are fixed for the A company and for the B company. So what you see here is that the change in operating profit for company A is about 27%, I would round it up, whereas for company B, it is 47%, almost twice as much. You see, company A is less responsive when it comes to operating profit to an increase in revenues than company B. Now, if I were to suggest you, which company would you pick? Which one would you pick as your favorite? Well, you would probably say B, right? Because the profit margin wise, company A is earning less cents on a dollar than company B. For example, if in the base case both companies were earning 15 cents for every dollar of revenue, then in the new circumstance, when we have a 10% increase in revenues, company A earns 17.3 cents on a dollar, whereas company B earns 20 cents on a dollar. And of course, again, I said that the growth rate in operating profit is much more pronounced for company B. So it seems like company B is the one to pick, right? Because the boost in operating profit is higher for company B. So that's a characteristic of what we call a cyclical company, or a company operating in a cyclical industry, the industry which is responsive, the earnings of which is responsive, much more sensitive to the changes in the stage of the business cycle. So let's imagine that this is our business cycle. Let's say we are on the rise. The economy is on the rise. The wages are increasing. The unemployment rates go down. Which company would you want to pick? Of course, that would be B, right? For the reasons I've just explained. But the company A, by the way, is, as you have already read yourself, is characterized by a higher operating leverage than company A. That's why it is the earnings of company B are much more responsive to the change in revenues. For 10% increase in revenues, the operating profit for company A increased by 27%, I repeat. And for the same 10% of revenues for company B, the operating profit has increased by almost 47%. That's the way to go, right? If you are at this stage of the business cycle, right? I'm somewhat simplifying, but this is a double-edged sword. I mean, the fact that a company B has a high operating leverage. Because what would happen with operating profit if the revenues slide down, decrease rather than increase? In this case, we would have a mirror image of this. The numbers are the same except for the profit margins, of course. But here you see that the operating profit decreases by 47%, whereas for company A, well, it's still a large number, 27%, but significantly less than company A. Now, if I ask you, okay, let's say you are at this stage, in the recession stage, or a contraction stage of the business cycle, which company would you want to pick? Now, would probably say company A because it suffers less than company B, right? So depending on the level of sensitivity to the stages of the business cycle, that's how we can categorize industries into cyclical industries or non-cyclical industries. Of course, then I said non-cyclical industries. That does not mean that the earnings do not respond to the stage of the business cycle. In the recession, of course, the earnings would go down. In a growth stage of the business cycle, the earnings, of course, will also increase. When I say earnings, I mean some kind of operating profit. Yes, but for cyclical companies, this change is much more pronounced. So the swings in earnings for cyclical industries is much more pronounced than for non-cyclical industries. I hope this is all clear, right? So depending on now, how does that fit in the equity analysis? Let's say you have a pile of cash that you are thinking about investing. So depending on your views about the economy, how the economy, of course, who knows that, of course, but we still try to bring up this curtain that separates the present from the future and try to peek into the future, right? Let's say you are thinking that the economy is on the rise. You have all the reasons to believe that the economy is going to show double-digit growth, for example. In this case, you would probably want to have an exposure to companies or industries which would have higher sensitivity in terms of the earnings to the stage of the business cycle. So if your view is, if you're optimistic about the economy, you would probably want to overweight cyclical industries and underweight non-cyclical industries. And the same reasoning goes for the case when we have a pessimistic view about the economy. We're thinking about contraction, and hence we would probably overweight defensive industries and walk away from cyclical industries. Okay. Now, another interesting thing about this is that okay, I would probably skip this or not. By the way, how are you doing? Do you hear me well? Are you comfortable with the pace of my talk? You can give me an idea about this in the chat, just putting a plus sign so that I understand it. You hear me well and see me well. Okay. Okay, thank you. Now, another reason, yes, I didn't yet get to the Porter 5 forces, but I thought it would be interesting to show this. Now, let's say you have you are looking at a company in a cyclical industry, what would you expect this company? Would you expect this company to have higher amount of debt or lower amount of debt? Usually, the companies in cyclical industries, all else equal, as we usually like to say in economics, you would have less debt than rather than more debt. Why? Because if you take into account the fact that if you take on more debt, you would have to service that debt. And what if the economy slides into recession? In this case, you would still your earnings will slide down, but you would still have to pay your interest payments. That's why it's very important to really, we don't want to learn anything. We would rather feel this, okay? So just to give you an idea as to how the financial leverage impacts the profitability of a company, let me show you a very brief case about a company that is it is forecasted to earn $500,000. That's what we mean, the base forecast, okay? Hold on, the base forecast. And let's say everything this company has is financed with equity, 2 million equity, okay? So in this case, of course, we don't pay any interest. The earnings before taxes is again $500,000, and let's say the taxes are 30%. We end up having 50 net income, and 350 over 2 million would, well, that should yield 17.5%, which means that for every dollar that the equity investors have put into this company, they are earning $17.5 cents for every dollar that they have invested in equity. Now, let's say we're making wild optimistic forecast that the EBIT would go up by 40% or it slide down by 40%. What would happen with the ROI, major metric that helps investors navigate helps them navigate in the financial world? If the scenario is optimistic, the investors would be able to earn 24.5 cents on every dollar that they have invested, or if the economy slides into recession, just 10 cents. Now let's imagine that we decided to swap equity for debt. In other words, out of 2 million equity, we would want to exchange equity for debt. How this is done? The company can repurchase its own shares and substitute it with debt. If it does so, let's say it does so, again, the company is still financed with $2 million, of which 1 million is debt, and let's say it is bearing 5%. It looks ridiculous now, right? In this environment of very high interest rates that we are living in now. But nevertheless, this is just an illustrative example. So we swapped equity for debt, which is 5% debt. So basically, we would have to pay $50,000 of interest payments. In this case, if you do the calculations, you would see that in a base case scenario, suddenly your ROI is pumped up to 31.5. So in other words, for every dollar of equity that investors have invested, equity investors have invested in this company, they will be able to earn 30 cents. Let's compare this with the previous example. 17.5, 31.5. Wonderful. So this is how the financial leverage works. Okay, it increases the ROI, return on equity. However, this is again double-edged sword, because what happens if you assume more debt? The riskiness of the business increases. By the way, if you combine these two effects, the high operating leverage effect with the high financial leverage effect, the degree of total leverage would be very significant, and that would indicate higher amount of riskiness, which is riskiness of the business of this industry, right, or this company. Now, Let's finally get back to Porter 5 forces. Again, just to wrap up what I've said so far, we're trying to categorize industries into cyclical, non-cyclical. Then we said that usually cyclical industries are characterized by high operating leverage. And if so, because their earnings are so sensitive to the stages of the business cycle, they would rather have less debt than non-cyclical companies. And then we get to the Michael Porter's industry analysis framework. Porter, that's the name for the for a Harvard professor. This method is very, very practical, and it helps you. It helps investors understand the industry or characterize the industry around the 5 forces that shape the attractiveness of an industry. Now, let's look at an industry from the standpoint of an investor. Let's say you are an investor and you're thinking whether to invest in a particular industry or not. So what is the Porter 5 forces? Basically speaking, Michael Porter suggested that in order to understand the structure of the industry and hence the attractiveness of the industry, we would be looking at 5 forces that shape the industry. First is the rivalry, the intensity of the competition within the industry. And again, here I would remind you your basic economics, microeconomics course, where we're looking at perfectly competitive markets at one extreme, and at the other extreme, we had a monopoly, right? So if you have a monopoly, there is no rivalry whatsoever. If there is, the market is considered to be perfectly competitive, then you would have a lot of participants and basically very thin profit margins. So the level of intensity is one of the most important factors that shape the industry. The second or the third, the numbering is not important. The threat of new entrants, or the barriers to entry, as they call them. The higher the barriers to entry into the industry, the more comfortable the guys living in this industry are. The lower the barriers to entry, the less comfortable the companies are, or the more the competition is within the industry. For us, the consumers, competition is a wonderful thing. But we are looking from the standpoint of an investor, and we want to invest the money in an industry which is not particularly risky and which pays us a lot of money. Well, that's a dream, of course, but so the barriers to entry is one of the forces. The other force is the threat of substitutes. The more the substitutes for the products that are produced by the guys in this industry, the more elastic the demand would be, and hence the less leeway for the companies operating in this industry, and hence thinner profit margins. So all else equal, the more the threat of substitutes, or the more substitutes there are, the more competition would be, the more competition, less profitability. Bargaining power of buyers. Who buys the products or services that are rendered by the companies from this central quadrant? The bargaining power of buyers measures the ability of the buyers to exert pressure on the price. Let's say we are in an industry which caters to just one buyer. And let's say you are a farmer along all the other farmers. Let's say we're looking at the farming industry, potatoes, which we deliver to, say, Magnit or Peterочка supermarket chains, right? For a particular region, a particular Peterочка or Magnit is the only buyer to you. I'm just constructing, hypothesizing, but it's not further from the truth, by the way. So what would be the bargaining power of Magnit or Peterочка? It would be significant. It would exert pressure on the farmers to lower the prices or to delay the payment, etc. So the more the bargaining power of buyers, the worse it is for the companies operating within an industry. And on the other hand, let's look at the retail chain where the Magnit and Pyaterочка operate. Of course, there are other retail chains. This is just the first two that came to my mind. What is the bargaining power of the buyer? When you enter Pyaterочка Magnit, you don't have any power because you do not negotiate the price for the bread that you're going to buy, right? The price is set by Pyaterочка, and that's it. You want to buy it, buy it. You don't want to buy it, go away. So there is no bargaining power on the part of buyers when it comes to us, the customers, and then we're looking at the retail industry as a whole, right? The other factor is the bargaining power of suppliers. Who supplies the major resources to the industry? If we are looking at a retail industry, for example, Pyaterочка and Magnit, the bargaining power of suppliers, so the farmers who supply potatoes, onion, etc., is negligible, right? On the other hand, what if we are looking at an airline industry? Who is the supplier to the airline industry? If we're talking about transatlantic flights, then most of the time we're talking about only two suppliers, Boeing and Airbus, right? Yes, there are other Embraer, Bombardier, etc., but especially for long-haul flights, the bargaining power, if you are an airline, the bargaining power of suppliers will be significant, right? So, in a nutshell, I tried to present you with the Porter 5 Forces framework, which helps you what's the idea again, to wrap this up? If the bargaining power of suppliers is negligible, this is good for the industry. If the threat of substitutes is negligible, this is good for the industry. I'm taking it to the extreme. Very high barriers to entry, so you are not afraid that the companies would come into your industry and will eat up your profit margins. This is good for the industry. If the bargaining power of suppliers is negligible, like the case for farmers supplying potatoes to Magnit or Pyaterочка supermarket chains, this is good for the guys here. Of course, this is dream come true, somewhat fictitious. Of course, you would not have pluses in all of the places, but the Porter 5 Forces industry analysis helps you to picture, to understand the characteristics of the industry, and hence make up your mind whether you want to invest in companies operating here or not. So I believe my time is up, unless you want me to continue. Just to give you a glimpse as to, we have a lot of other slides here going on, but I would probably stop here to see if you have any questions. How can we quantify? Thank you for the question, by the way, Kirill. How can we quantify the 5 forces to take them into account? There are different ways how you can quantify this. By the way, it's a very good question. What ROI would you expect for a company? Let me answer to your question with a question, because that probably might be useful. If you see that the profit margins in a particular industry are very thin, as measured by the ROIs or return on assets, that would give you some understanding about the attractiveness of the industry. This is one way to go about this. By the way, this analysis does not always involve some complex calculations. No, you just need to, okay, how many, one of the ways to go about this, how many people are there? How many companies are there cutting each other's throat, competing with each other? That's one way to ask. At the one extreme, you might look up at 3 companies. At the other extreme, you can look up at the industry is characterized by 100 companies. This is one of the ways to numerically quantify this characteristics of the industry. This might be somewhat unrelated, but since we are on the topic of business cycles, I'm just curious, what is your take on the Austrian theory of business cycles, particularly the idea that business cycles are precipitated by the inefficiencies of central banks? Yeah, I'm familiar with this theory, which has been developed, if I'm not mistaken, after the Great Depression. It's hard to tell me. I wouldn't consider myself a full-fledged economist, but you know what? Every theory, we have classical economists, neoclassics, Keynesian, neo-Keynesians, monetarists, etc. Each school of economic thought gives something valuable, which helps us better understand the intricacies of how the economy works. So I would not, I wouldn't say that I am a particular fan of any particular school of thought. All the schools have something to offer, but I would refrain from saying, because I don't know what central banks we're talking about. By the way, the actions of many central banks, particularly the Russian central banks, many people criticize the actions of the central bank because the Q rate has gone up, as you know, with ripple effects on the economy. Some people praise, some people criticize. As the Hegel said, as you have argument and counter argument, in the end result is the synthesis, which sheds more light into the actual underpinnings of the economy. So I would refrain from quantifying, qualifying any school of thought. No, it's not a dumb question. By the way, any questions are welcome. No dumb questions whatsoever. I believe I missed your question. How does the intensification of network interdependence challenge the predictive capacity of Porter's threat of new entrants and bargaining power forces in high-tech monopolistic competition? Google, Amazon. I'm not familiar with this industries, to be honest with you, but it's not the predictive capacity, by the way. Porter's five forces tries to describe the industry as it is. What would be your take based on what you have found using the Porter five forces is another question. Of course, you would use the insights that you would gain from the Porter five forces analysis to shape your forecast. After all, you do this analysis because you want to shape your expectations or to shape your thoughts regarding the future. Okay. I'm in a fast mode, so pardon me for at times being too woody. But at least I'm trying to make the more we talk, the more during the actual classes, the more questions we ask, the more interactive it is, the better it is, the better it would be for you. Any other questions? I'm not sure whether I have addressed all the questions, but seems like that would be it, right?
Okay. And while we are waiting for more questions, I just would ask, should we repeat the questions for our applicants to write an essay? Oh, one more.
Yeah. It does. It does. By the way, again, that reminds me about an example of oligopoly. Why the companies within an oligopoly are characterized by interdependence. Whatever someone of them does would impact what the other would do, right? Now, the increasing interdependence, mainly for technology, reduce the likelihood of competitors. It might. I'm a little bit, I refrain from using some qualifications regarding tech industry because I'm not an expert in this industry, so pardon me for not going deep in this. As about the questions that I would ask you, open-ended questions that I would ask you to think about, because it might be an interesting exercise on its own. One is, pick an industry of your choice and describe it using Porter 5 Forces framework. It's not difficult at all, and it is interesting. That's the key thing that I would really want you to concentrate on. You can take an airline industry, you can take oil and gas. By the way, you can use statistics, from the State Statistics Service. You can use industry classification used in that, как он называется, этот сайт? Slipped off my mind. So one is, pick an industry of your choice and describe it using Porter 5 Forces. And the second one is this: since we are living in an interesting environment of high interest rates, what is your take on the impact of high interest rates on the equity market? Open-ended questions, ample room for creativity. So that would be it from my side, unless we want to add something else.
Okay, and let me just remind our guests of our project rules in general. So by attending our meetups, you can get additional portfolio scores while you during the admission to our master's programs. So to get additional points, you need to do 3 things basically: to attend our meetups, to write an essay on an open-ended questions, like those which you just heard, and the last task is to write like a review on the whole project, and to send it to us before the official admission dates start. So you are also free to join our official Telegram channel, where all the recordings, all the webinars are announced. So please join. I just shared the link in our Zoom chat. And if you don't have any questions, I think we can finish here. So Хачатур Леваевич. Thank you for the, like, I think one of the most interesting lectures
Thank you,
of
much
the whole
appreciated.
project. Yes. So, and thank you all, our dear
And
guests.
best of luck.
Yes, our dear guests, our dear
know you
applicants.
understand.
Thank you all for just attending our meetups, for joining them like the fourth time this year. And I hope that we'll meet next time in Zoom all together.
Thank you. Bye-bye.
Thank you.